Kitco Mining's special coverage of the Precious Metals Summit in Zurich is brought to you by Vizsla Copper.
Careful what you wish for $5,000 per ounce gold. This is Paul Harris for Kitco Mining at the Precious Metals Summit in Zurich in Switzerland. Joining me this morning is Julian Brigden, co-founder of Macro Intelligence 2 Partners. Julian, welcome to Kitco.
Thank you very much, Paul.
To start off with some quick summary for our viewers. Who are you and what do you do?
So MI2 Partners is a research provider, mostly to the sort of institutional community. So we've been going, 11 years now, actually, it's quite a long time. And we have a sort of cross-section of everyone from macro hedge funds to big money managers to family offices and some individual investors as well that we get involved with via Real Vision.
And it sounds like they want to know the big picture stuff.
Yes.
Okay, there's been a lot of talk this morning about the macro environment, as you would expect at a precious metals event, and particularly the US dollar. US Treasuries auctions didn't go well last week. However, the US dollar index has continued to be relatively strong. What does all this mean?
So I think, look, we have to sort of pass some of this down. You know, if we look at the Treasury market, we've been structurally bearish on Treasuries really from sort of 2016. We think just the long term, and I'm talking very long term, structural trend now is for global yields to rise. You know, we had a break during COVID, obviously, because that sent yields crashing, but the structural trend, whether you look at sort of demographics, pool of available savings, demands from countries to issue debt, right? Because we are arguably fighting 3 wars if you look at the United States. We have a Cold War with China, we have a hot war with Russia, we now have a hot war in the Middle East, and we have a climate change war, right? Vast quantities of government spending. Somehow it has to get funded. Pressure is for yields to rise. So we think we've kind of hit this, well, we're getting close to sort of a turning point in fixed income. We'd had a longer term target of 5%. We got there on 10-year Treasury yields. So kind of where we go from here, I think depends a lot on some of these other risk assets. The dollar is one of them. I think a lot of people, particularly in the precious metal space, really want to see the dollar crash, right? You know, and structurally, I'm a big dollar bear. I just think it's the question of when you hit that tipping point, and timing is really very, very important. And, you know, if you look at, say, the euro's got its own problems, sterling's got its own problems. None of these currencies are great. That's why I think people like gold. But if you really want to see gold take off, you've got to see a Fed that not only pauses, but starts to cut rates. And I think, personally, we're quite a long way away from that. And I think people don't understand the policy framework that the Fed's trying to pursue.
The message seems to be coming through that higher for longer is the outcome that we're now going to be living.
So I think, look, there are two, when you have inflation of this sort of magnitude, particularly when you have low unemployment as well, which doesn't give you a lot of flexibility to grow above trend in a non-inflationary way. There's really sort of 2 policy options you have. There's what was referred to as deliberate disinflation. This is sort of the Paul Volcker, where you deliberately kill the patient. You drive the terminal level of rates to such a high level that the economy dies, dead, done. Inflation, everything's killed, right? But obviously at a huge cost to individuals and to government deficits. The second option, while more benign, isn't without its problems. And this is called opportunistic disinflation. And this means that you trade off essentially that ultimate level of terminal rates, Paul, with how long you keep rates restrictive. And so I think the big problem that the market's got is it continuously looks for, you know, the muscle memory we've built up since the global financial crisis. Rates go up, immediately cut, right? And I think we're in a very different framework. I think we're in a framework where, you know, to use the vernacular, higher for longer. And we just sit here for a long time. It doesn't mean you couldn't get, a slight tweak in rates, you know, as inflation drops a little bit and they don't want real rates to rise too much. But this idea that we've risen them now and now the next thing is cutting and risk is off to the races again, I think is utterly wrong. The intention from all my policy context is this is going to take a long time to grind things out. And when I mean long, I'm not talking necessarily months. I'm talking potentially years of restrictive rates with sub-trend growth. And that's bad for all assets.
Well, one of the questions I've got down here is the question, are interest rates biting enough? And what would be the evidence that they are? People are still going out and buying a $6 coffee or $10 fruit juice. You could argue that they're not really hurting if they've still got, the discretionary spending's going there.
So I think it really depends. So I was chatting to some people this morning before the summit kicked off about, where rates are restrictive. And I like to look at rates not just on an inflation basis, so not just pure sort of real Fed funds minus CPI or something like that. I actually quite like to look at them against a nominal GDP basis. So real growth plus inflation, and then where rates are relative to that. And if you look at Europe, actually, traditionally what would be considered tight rates in the Eurozone was when nominal GDP and rates were the same. So zero spread differential. We're plus 100 at the moment, which is actually quite tight for Europe. In the United States, if you take that same metric, typically tight would be plus 100 basis points. We're minus 200 basis points. So I think it's entirely arguable that rates are not that restrictive yet in the United States, to your point, right? There's still a lot of momentum here in this economy. There are signs on the periphery that we're seeing sort of weakness. But even sort of some of the cyclical areas like manufacturing have actually started to show signs of basing to potentially even relaunching again. So I think you could make a case to say that this is arguably not yet restrictive enough. And I think a lot of that comes down to this robustness and resilience of the equity market.
Obviously, the intent here is to cool the economy, and there are already a lot of families all over the world that are hurting from this.
Yeah.
But with the US government now paying $1 trillion a year in interest, is there a danger that it's actually going to be the government that breaks first rather than the economy?
I think that's a valid question, right? And I think one of my big concerns is something we've been writing about to clients is this point where you slip from, I don't want to get overly too technical, but there's what's referred to as monetary dominance, where a central bank focuses on monetary policy to control, typically inflation. In the US, obviously, with employment as a mix. Where, however, if your deficits get so large, ultimately the central bank, as one of my clients likes to say, they've only got one objective, and that's the solvency of their boss. In other words, the government, right? So that you can hit this point where the level of debt servicing and the amount of debt that's being compiled is so great that the central bank is forced, however objectionable that may be, to kind of cross this Rubicon. I don't think they will do it lightly. I don't think we'll do it without pain, where you slip into what's referred to as fiscal dominance. And then the objective changes from employment and inflation to stability of government debt. And with that comes a raft of other potential financial repression-y kind of things that we would expect to see. I don't think we're there yet. I think there is a risk. I don't want to say an inevitability because nothing's ever guaranteed. I think that's the weight of the direction that we're probably going. When do we get there? Might take another election. Might take a Donald Trump coming in and saying, "Oh, I think we should spend even more money." At which point the Treasury market goes, "Are you kidding?" Right? But I think that's at the moment, I just don't hear, we've seen some rumbling from someone like DeSantis about fiscal rectitude and balancing the budget, but it's not really mainstay, right? It just isn't. And the concern in the public isn't there.
Okay, let's bring the conversation more into sort of gold. You touched on it briefly. Ronnie mentioned this morning, Ronnie Sturfley of Incrementum, how pretty much the non-Western central banks have been buying up gold by the fistful, swapping out their treasury bills and bonds for the yellow metal as perhaps the continuing wave or accelerating wave of de-dollarization. How would you view the gold space in all of this?
So look, I'm structurally very positively orientated toward precious metals. I've got quite large, percentage holdings in my own portfolio. I think, though, one's got to be realistic. As I said earlier, I think if we're in an environment where policy needs to remain tight for now, I think, excuse me, I think that doesn't leave much opportunity for any assets, right? If policy works via financial conditions. Financial conditions are essentially a basket of asset prices. And if financial conditions have to remain tight, asset prices in broad terms can't go anywhere. Now, maybe gold could go up, but then bond yields have to go down, or stocks can go up, and bond yields have to go up, right? We have to keep that thing stable. So I look at precious metals, I like them as a holding. Do I think that anything is really going to perform over the next year or so? I'm not sure, right? I think some dynamics would have to change dramatically. I think for gold to really break out, you have got to see the equity market break down in the US. You've got to see the Fed then truly step back and start to cut rates and the dollar to go. That, I think, would set you up for this solid breakout that we want. And, maybe at that point, our initial target on gold would be around 2,400. But, some of these more outlandish 5,000, 6,000, you and I off camera were talking about, I'm not sure we want to be in that world.
Well, yeah, that's want to sort of get a bit more precision from you on the breakout we want, because some people will take a rapidly accelerating gold price as a sign that other aspects of the fabric of human society are unraveling, and nobody lives in an isolated enough condition to be immune from that if that happens.
Well, no, I mean, Grant Williams and I were, I don't know, you probably might be interviewing him, we were chatting last night about this, and we both have got this somewhat maudlin sort of long-term view of the world. But it isn't such a great one. I mean, I think you've got to start at that point to considering things like, okay, so I've got my gold, how do I have my gold? Right? Is it in some trust? Well, that's frigging useless, right? If the muck hits the fan, where do you have it, right? How are you going to protect it? Where are you going to be living? It's great. Maybe you have got a whole bunch of gold, but you live in Manhattan or you live in central London and there's riots going on everywhere. I did have one client of mine who said, I've got all these kilo bars that are in Zurich. I remember this conversation and I said, oh, so end of the world, you're just going to jump in the super lightweight Ferrari from Sevenoaks and you're going to drive through France, which won't be rioting, turn up at the borders of Switzerland and said, oh, it's Mr. X coming to pick up my kilo bars, and they're just going to let you in, right? I mean, it won't work like that. So I think we've got to be, if we do get to that point, and I'm not talking, this is way beyond a sort of 1970s period of extended high inflation and a nasty world, but I'm true like societal breakdown, which I think some people at this conference may slowly, quietly lust for. There's lots of other dynamics that come into play at that point.
So what you're saying, in 500 years' time, people are going to be digging up a whole bunch of gold caches all over Europe and the Western world, well, China as well.
Yeah, look, I think we're probably, I hope we're quite a long way away from that. And there'll be plenty of opportunities to make money in the interim. But I think, one of the things that struck us, we had a macro conference, MI2 had a macro conference a while back, and I got kind of my friends together, because I think I've got a smart group of friends who and a couple of them were registered investment advisors, so people truly managing, individuals' portfolios. And they're talking about wanting to have 25% of the portfolio in precious metals. Right? And as a combination of managing volatility around an equity portion or a credit portion and no longer wanting to own fixed income. And that, I think, as Ronnie and Slides pointed out this morning, in the West, we're still generally dumping. Now, if these guys that I had at my conference are the leading edge of that, at some point, that Western pool of cash, albeit late, is going to wake up and going to go try and pile into this tiny weeny space, right? We all know how big the equity market, how big the precious metal market is. It's going to be, look, bottom line, I think there's plenty of opportunities before hopefully we have to lie on the bed, drink our bottle of Burgundy, take a few tablets and call it quits.
So for you, what is a healthy investment strategy for people during these times?
So I think, look, I'm very wary of longer dated fixed income, extended duration. I certainly in the Western world, I think the bond markets, tactically might be a good buy here, at 5% yields, but it's a tactical view. I think we're in a structural bear market. I like certain equities, generally not in the United States. I think US stocks remain extremely overvalued, and everyone owns them. That's the problem. And I think, though, that we've got to be a little careful in any outright assets purchase, because typically going into the reflationary trade, when gold and silver, especially silver, will really take off, you end up with an extended period of volatility where you get stress across all asset classes, because technically it's referred to as a VAR event, right? All portfolios get stressed by higher volatility. And the risk is there that if you're very committed outright long any single asset, gold and silver might relatively outperform, but they could absolutely decline, right? They might not drop as much as, say, the NASDAQ. The NASDAQ drops 50% and your gold is only down 10 and your silver is only down 30, but you're down 30. Right? So I think in this period, you've got to be quite careful about how you manage risk in your portfolio. And ideally, if you can, if you want to own gold or you want to own certainly something like silver, when you get nervous about valuations, sell something against it, right? Sell NASDAQ or, sell bonds or whatever, but you've got to manage that overall risk in the portfolio.
Okay. Now, looking ahead to 2024, how do you think some of these trends or themes will play out? What are you looking forward to?
Yeah, so I think in 2024, as I said, I think our big disagreement is this idea of a very rapid rate cut scenario and a re-acceleration of growth. I think we're more likely to be in a kind of choppy trading range, at least to begin with, where we can switch between asset classes, but there's not a lot of overall gain across all asset classes. I think that these central banks will be a lot tougher than people imagine. And as I said, I think that leans itself more, absent, let's say, something cracking in global equities. I think that really leads us more in this choppy trading environment.
Okay, excellent. Well, Julian, thank you for joining us today.
Pleasure, Paul.
And this is Paul Harris for Kitco Mining at the Precious Metals Summit in Zurich, Switzerland. And if you like what you see, don't forget to subscribe.
Kitco Mining's special coverage of the Precious Metals Summit in Zurich is brought to you by Vizsla Copper.